11/3/2013, 919 was a time where the S&P was getting ready to reverse on that date. Now here we are on 11/3. What I really want to talk about is the overbought processes here. This is a weekly chart on the S&P 500 that hit our target at 1775. We ran the full gamut from 1650. We ran 120 points to the high side in a very short period of time. Unlike any other time, when we call the top for a correction or pullback, we are here again, and we're going to pull back in the month of November. We are extremely overbought on the weekly. When I show the monthly value, you can clearly see here that 1761, we hit 1765. This is what it looks like on a monthly value. The daily value of the chart is as follows. Parabolically, this was the government problem right here. It hit our target. This was the last correction that we had called for. The data that you would like to look at as far as indexes go, they're all archived here on stockmarketfunding.com. You can go back and take a look at the tops that we had called in the past. Short overbought levels. Take a look and review them compared to what we're talking about here. One of two things are going to happen. Either we're going to come up and test that 1775 area, or we can slightly make another higher high briefly intraday before the reversal. What happens is that we've ran too far, too fast, and we're extremely overbought again. The weekly chart is floating right up here at that 1775, and there was distribution. One of the things that we're going to be looking at is the January 14 calendar year 1775 put. They're $50 a contract. They're very cheap, and they've been marked down to wholesale prices. The other contract we're looking at is a January 1770 put. Regular monthly expiration at $47 a contract. So when this S&P corrects down here to 1700 is our price reversal correction pullback before going into 2014. The other contract that we're looking at is a December shorter term contract at $42.40 that would have to be managed appropriately. One of the things that I will show is the following. Here is a put chart on the S&P 500 index. Let's go to a daily where you can see here in the video that these contracts at one point, because there wasn't a lot of them traded going out that far, the value was $83. The low, $44.60. The current value is $50. These are totally deflated. The put to call ratio, and let me give you an example. Let's take a $1,750 call. Here's what happens with options when they get overvalued. They will never stay up here. Just like when we called over here. They were going to come straight down, and they did. So we're at another higher peak. This contract is going to come down, just like they did over here. Right here where they were overvalued at times, and they come smashing down. It happens in every market, whether it's a call or put. It doesn't matter. What does matter is that they're extremely inflated, and they're going to come all the way down in value. That's the 1750 call that was in the money. And this is how we can tell. Look, when we take a look at a call option over here, and it's all January, we're going to look at the 1730 call. That's in the money. $17.30 call, $57 a contract. They were down here at a very low price of around $19.70. They're totally inflated. They will be coming down in value. Put to call ratio, when we look back in the markets 1 year ago. We take a look at where the call side of the market is in options and the put side, and we take a look at the mathematical imbalances. S&P 500, $1,700 call. January 2014. We went straight up to the ceiling up here, right below $80 a contract, $78.35. They're inflated. They're coming down. Back over here on 9/19, as I said in the beginning of the video, we said we were due for a pullback and a correction in the S&P 500 index, and how right we were. As that index corrected and fell, these inflated calls at the time, 1700s, came smashing down from the high of 61.50 to the low of $30.50. And then they ran $50 a contract. Now, when I go back to the SPX.X, S&P 500 index, we can clearly see that in some of the overbought calls versus the puts is that we've started a mild pullback. They always start like this. When we take a look at the SPY, the SPY, we can see that the SPY has the same thing. One of the things that we're going to be covering on the SPY is so the SPY is going to correct down here where the breakout was. We're looking at 167. And we're looking at so that's $167 on the SPY for this pullback correction, whatever you want to call it, that it would set up for a year-end rally by having a pullback. There are other support levels that we're just featuring the lower level. So by having put options on the SPY, they're about $2 for the 177. They would go to $7 in value. That's a $5 move. So there are some other type of, you can buy put options on the SPY, which is different than the SPX. But we can clearly see that every one of these corrections that we have called for have played out. And remember one thing, this overbought process and the extreme exuberance that's in the markets right now is that you will not have a Thanksgiving or Christmas rally at these price levels. You will not. However, on the other side of what I'm saying is, with the nice pullback here to 1700, right here, 1700, that's right about where that resistance, we broke through it and we ran to those highs, that would be healthy for the market. Then I could say wholeheartedly that we would set up for that January effect, and that rally would take place with the pullback. So remember, this was a government-induced pullback to the lows on the S&P, and we've gone straight up to the very highs of the S&P. Overbought more so than we were here. We were overbought here and had to correct. We were really overbought here and had to correct. But now we're extremely overbought. And let me tell you something. On the XLF, which is the financial spider, this has already started its correction. And as a matter of fact, we were not able to take out this high right here. We made this high from that. We bottomed out. We rallied up and we kind of pulled back a little bit, but the financials are not participating and making higher highs like a lot of the other stocks and other indexes and other ETFs are. They had to have great corrections that we called for here in the financials. And the financials, when we take a look at Goldman Sachs made a peak. It did not recover with the market. Didn't make higher highs. Here, let's take a look at JP Morgan. Made its all-time highs over here. When we were at the bottoms of the market, JP Morgan never made another high and never broke these other highs over here like the broader indexes did. It's one of the bellwethers here. AIG, same thing. AIG just reported quarterly earnings. It's another, it's in that sector. Look, we made the high, we pulled back. Here's the earnings report, we come down. But The financials never, here's the rally in it. It followed the broader indexes when we put in the bottom. But the thing about some of the financials, they're not making new higher highs. Like always, this rally here, once the government got out of the way, we got more exuberant and more exuberant and more exuberant. Unfortunately for the bull, they always get caught at the highs and they always sell out at the bottoms. This is what's happened in the calendar year of 2013, all the way up until November 3rd today. So, what we're clearly saying, a new pullback is going to come in play. It's time to take profits. People that got involved in the year, when we started out the year of calendar 2013, it's time to take money off of the table. We've seen the last 2 weeks where there's been some broad-based selling finally, and we're going into a new calendar year. We've got November and December left, and we're closing it out. 2014 will be quite different than 2013. That will come at another day. That's a new chapter that will be opening up, and you can stay with us. The thing that I am telling all of our bigger traders is that we're looking for the 1700 as that lower support level. You will have lower support levels all the way down here. Depending on what happens with the government, again, is that the government's going to come back and we get into the little fiascos that we did with them last time. We'll have a much deeper pullback, much deeper correction. That's yet to be determined. That's going to be based on government behavior. Stay tuned for this S&P 500, and we're very happy to tell you that in each one of these overbought processes that you were going to pull back in the bull. Bull has to have a pullback. Exuberance needs to be punished. What do I mean by that? People are gambling up here. This is overbought. You don't make money buying up here. You make money buying down here. Or you make money buying down here. Or you make money buying down here. But you don't make money buying at the highs and then them correcting severely on you. That's exactly what's going to happen here within the next 60 days.